Welcome to the AAAG, the African Association of Accountants General, a Pan-African platform for collaboration amongst the offices of the Accountants Generals from the 54 member countries to sit together and reason together on how best we can structure PFM to value add.
Today, we are experiencing and witnessing the second annual conference for the association, and it is bringing accountants and professionals in the public financial management sphere from more than 20 countries of Africa, but we also have attracted speakers, experts, and guests that are coming from beyond Africa, that is from America and some from the Europe. And we are predominantly working on promoting accountability, integrity, transparency, and collaboration. These are the key steps that we are making sure that we stronghold and our activities and our initiatives are protecting.
I'm Nusanta Dlamini. I'm from the Kingdom of Eswatini. Today we learned a lot in terms of how to care on our profession, in terms of us improving ourselves, capacitating ourselves, and most of all, my take home for today was that we should ensure that we have ethics and also stay away from fraudulent activities.
The main challenges that we are working on and that we are solving is capacity building of the professionals in the African continent. The second one is to ensure that we improve and we reinforce and have the latest of the systems in our working space. The third one is to make sure that the legal framework that we are working on the public financial management is up to date and is the latest.
This theme is at the core of our future livelihoods. When you talk of sustainability, sustainable public finances and governance must never be left out. When you talk about sustainability, sustainable accounting practices must not be left out, because when you want to fund sustainability, you must then think of what sustainable streams you're going to put in place. Now, public financial management, therefore, is at the core of sustainable discourses. It is against this backdrop that the AAAG did organize this conference and putting together all the accountants generals, the accountants from across Africa, to have a discussion around this, because sustainability is a topical matter that beset this globe. Often we hear of global warming, we hear of degradation of the environment, we hear of famine, all of which have a cost on the public finances, because governments must thereafter roll out interventions to cushion the population against the harmful effects of these extreme weather conditions. Consequently, we must think sustainability even within the confines of government operations. It is for that reason that we have chosen the topic.
There was a quote from the conference yesterday which really resonated with me, which is that trust is very difficult to earn but very easy to spend. You can lose it very easily if you are not being seen to be responsible. So it's not just about being responsible with public money, but being seen to be responsible, being visibly taking care of money, making sure it is collected appropriately, guarded correctly, and spent judiciously and on things which benefit the populace. If people can see that this is happening and they believe and trust it, then they will be more engaged with their government, they'll be happier to interact with government systems, there'll be less resistance to collecting of taxes and revenue, because they understand that the money is going to good purpose. So it's a really important, and for that there has to be a system of accountability and transparency. It has to be that the money is properly collected, people can understand where their government is taking the money from, what they are spending it on, what value they are getting as a result, and be able to verify this with trusted systems as well.
From next year, there's going to be a specific sustainability reporting standard for public sector. And another thing which I am not covering in my slide is that there's also an audit standard, an assurance standard for sustainability reporting as well, which means going forward we should expect that there will be audits being done on those sustainability reports as well, so you can see how fast this landscape is changing.
For the fact that the Association of Accountants General is trying to force that into the PFM bill, I'm really happy to announce that there are a lot of impact that has come in place for now. When we talk about most of my member countries, they are making use of a financial system. When you talk about integrated financial management system, the IFMIS, they are in place in many countries. And then also the other countries, or most of them, have also introduced what we call accounting reporting framework standards, though there are still those who are still enduring that journey, but at least the political will is there and we are moving towards that. And being also an association that is trying really to do a lot for the professional, there are trainings that are being slaughtered on a yearly basis that are meant to capacitate our accountant in the public sector. And also to mention that there is also one that is now born through the African Union, which is we call an API. This API stands for Africa Professional Initiative, and that is aimed to qualify the public accountants who has the experiences and they are in the service, but they need to be qualified. So far, I could say there's really a big impact, and we are still moving on and fostering whatever is remaining until we reach the goal.
Good afternoon, good evening, good morning from wherever you are you are joining this meeting from. You're welcome to one of our monthly series. Today we are discussing a very topical issue. It's one that we never pay much attention to. We're discussing the cost that is invisible. You never find it in your traditional ledgers. It's never in the budget. But still, it is there, the cost of risk. Whichever angle that you're looking at, whether government is undertaking a huge construction project, procurement, sourcing finances, whichever angle that you may look at, this is a risk that we normally face, but rarely do we pay attention to. This is what we'll be discussing today, ladies and gentlemen. At this juncture, allow me to call in the Chief Executive Officer of the African Association of Accountants General, Mr. Frederick Liaga, to give us the welcome remarks to all delegates, as well as to recognize the presence of dignitaries who are here. Mr. Liaga. Okay, while Mr. Riaga is just patching up, trying to join in. So in terms of the speakers that we have, we've got quite a powerful array of speakers that we've lined up. We'll be joined by Mrs. Rolla Robinson from the US, who would give us a global perspective on this topic. Would also be joined by Mr. Amania Alani Kabisiaki from Uganda, who would give us the country experiences from Uganda and how the Ugandan Petroleum Authority, where he got that experience, how they have embedded strategic risk management into procurement, into financing. Mr. Riaga? Sorry, ladies and gentlemen, we had a small technical glitch, but I think it's now sorted. Allow me to invite Mr. Riaga to come in and welcome the delegates as well as give his opening remarks. Mr. Riaga.
Thank you, Bruce. Good morning, good afternoon, good evening from wherever you're joining us. On behalf of the Secretariat team of the African Association of Accountants General, let me take this opportunity one more time to welcome you into this series of webinars aimed at enhancing knowledge amongst the PFM practitioners across Africa on topical issues. Today, we delve into discussions around matters obtaining the right cost of risk, even as we engage in the big projects that you'd see getting implemented across Africa. The question would be, does Africa get the correct way of involving in the huge procurements that it undertakes? And as my colleague Bruce has indicated, we have with us two leading minds in the area of extractives who would then be leading us and pointing us to what sorts of strategies Africa can employ to derive better value out of its engagements with business partners or development partners. Permit me to recognize we had expected the chairperson of the association. I know she could be in, Madam Mahase, the Accountant General for the Kingdom of Lesotho. We expect Accountants General to be joining us in the next few minutes, but in the interest of time, permit us just to begin. I have with us the representative of the Accountant General of the Republic of Zambia, Madam Milika Musonda. As we are an association hosted under her office, let me take this opportunity to invite her into giving us welcoming remarks into the Zambian space, because we are relaying these from Zambia. We want to thank you one more time for your time to join us. We seek collaboration with you at whatever level. As AAAG, we exist to support. Whatever support that you require, to the extent that we have ability to deliver, we will deliver on them. But where some of our stakeholders have the capability of delivering, then we will tap into our networks within with them to afford you that level of support. Thank you very much for your continued support. Let me hand over to Madam Milika to give us our welcome remarks. Over to you, Madam Milika.
Good afternoon, everyone. Good morning, good evening. Welcome to this monthly webinar. Yes, we are hosting the Secretariat, and Accountant General should have been able to join us today, but she's just been called to other duties. So I'll be sitting in for her. Our topic is an interesting topic, and I'm urging every one of us to actively participate, ask questions so that it is as interactive as possible. I want to say welcome to the two presenters. I believe we will have a good interaction. Thank you. Over to you, CEO.
Thank you, Madam AG, for the welcome remarks. And indeed, it's a call to have an interactive session. At this point, ladies and gentlemen, allow me to call in the first presenter who has wealth of experience with over 20 years of global experience managing government projects, as well as providing advisory on development of high-value long-term projects. She has worked in over 5 continents, having started off with a career at Deloitte in Los Angeles, where she spent quite a number of years, over 10 years. And then afterwards, she founded Swale House Partners, where she's been involved since 2015. Her name is Mrs. Rora Robinson, who has also trained and advised governments on various aspects of risk management, ranging from petroleum, mineral resources, a whole range of activities. She's also facilitated a lot of workshops for board of directors, senior management, and as well as government officials. She's currently the past president of the International Consortium of Government Financial Management, which oversees public financial management from around the world. She's also a chartered accountant, like many of you would be here. Ladies and gentlemen, at this point, allow me to bring in Mrs. Rora Robinson to share her insights on this conversation today. Rora, over to you.
Thank you very much. It is a pleasure and honor to be here with all of you. I appreciate AAAG for the invitation to come speak to you today. These are some very important topics. And before I go into the presentation directly, I wanted to highlight that this is an industry that has been evolving very quickly over the last 30 years. And my colleague who will be speaking just after me and I have been addressing this issue, I think, together since 2019, and actually with some of you on the call. With Mr. Riaga, we had the opportunity to do this in 2018 and 2019 as well in Kenya. So I'd like to highlight that there is so much that is happening, and particularly on the continent, but it is not addressed to the extent that the risk exposure exists. So thank you again, and I'll jump into the presentation. Shall I share my own screen? Yes, I'll share my own screen unless you let me know. Okay. One moment. All right, can everybody see that?
Yes, we can see it.
Okay, wonderful. So before we start, I'd like to encourage you to use the chat for any questions or any comments. And Mr. Riaga, please feel free to jump in if there are any pertinent comments, because I can't see everything at the same time. So we'll be discussing the cost of risk. Now, for those of you who are unfamiliar with risk management, I've got a slight introduction on the definitions, but this assumes that everybody has some understanding of exposure. And so what we're really talking about is how big is the cost and how do you manage it? And with the introduction to this webinar, we highlighted that the cost of risk is everywhere. It is not a line item in accounting. And as a CPA, I really tried to identify the cost of risk. What is it? How do you put it on the books? What's the accounting standard for this? But it wasn't available. And so I went into risk management to look at accounting for uncertainty and how we go about managing that, because the cost of risk for governments is bigger than just about anywhere else in the world. And my focus is extractives, but I'm not going to go into that focus today because our next speaker will be doing that. I can. There we go. All right. So risk is the effect of uncertainty on objectives. That's ISO 31000. That's in most of your risk management guidelines. Risk management is the coordination of activities to direct and control an organization with regard to risk. And enterprise risk management is the approach to managing risk across an entire organization. These are all disciplines. Risk management and enterprise risk management are disciplines within themselves. Now, we do some work that we call tensegrity risk management, the approach to managing risk across different organizations from related risk events. So this is things like risks that affect both suppliers and the government, or natural resource companies and the government and the people and other entities. And so we really look at how do you manage these shared risk events, because those are the ones that will cost the entire project and are really the ones that affect public value. And the cost of risk is the cost of the impact of risk plus the cost of risk management activities. Now, there's no one definition for the cost of risk, but you'll find it throughout the insurance industry, finance industry, et cetera. But ISO doesn't exactly define the cost of risk. And it's a balance. So just like everything else, it's a balance in the risk management activities and the risk exposure. And if you don't understand the cost of risk, risk management becomes a question of should we do it, or maybe we're doing too much. So the cost of risk isn't a line item, but it's charged to governments in every line item. It's included in the most obvious way in sovereign debt with the debt rates, government operations generally, so your staff, your people, your goods, your general purchases, procurement of goods and services, capital projects in a significant way, natural resource developments, which is where I spend most of my time, and every activity in government. So take a moment to think about an activity in government and where that uncertainty is and how that uncertainty impacts your organization. Now, the cost of risk is likely over 10% of government spending. Also over 10% of government revenue. There is a significant opportunity by understanding and managing the cost of risk to reduce that by 5%. You'll never get rid of it completely, but reducing the risk by 1% of value, total value, so minus the risk that or the risk management activities that you're implementing. But there is a significant opportunity, and we'll talk about that in the oil, gas, and mining industry, as well as major procurements, transportation, and other activities. What does it look like? So if you're trying to figure out where the cost of risk is, it's incorporated in borrowing rates specifically, in discount rates. So discount rates are borrowing rates generally plus the cost of risk. How much is money worth, and where can an organization put their money elsewhere? So you're looking at the competition between other buyers when that comes in. So in the natural resource industry, if you have petroleum or minerals, the discount rate is how much could an organization make somewhere else And that's where they're looking at opportunity cost and how much they're going to charge you. The risk associated with that can be significant, especially as it comes to how much is produced. So I've got that further on in this slide, but how much is produced? Companies will produce as much as they can, and most of the contracts say commercially available or commercially viable. And if that's the case, those commercial terms depend on the discount rate. So the discount rate involves the risk, and that's where you look at a difference in a total recovery of mining or a total recovery of petroleum. So not to get into too many details, but the average total recovery of petroleum across the world is about 28%. Technology improves that, risk reduces that. So in Africa, there are opportunities to improve that total recovery about 10 to 15% through the continent in general. Each country has a very specific piece, but if you're not asking the question, you're not able to do any of the management associated with that. Cost of risk comes in with insurance rates or the ability to get insurance at all. It comes with security costs or security at all. Theft and fraud, corruption and unofficial fees. I'm not going to go into detail on this, but the activities around public financial management and corruption management are significant. That all gets folded into the cost of risk and how much companies and entities are charging an increase in order to manage that risk. Delays in approvals, delays in access to locations. And we've seen significant delays when it comes to getting through customs, goods getting through customs, or access to sites, especially when they're difficult to access. So things like minerals in Kenya, the north, in Turkana, trying to get there, the bridges, what does it look like during different seasons? Those will all get incorporated into the cost of risk. Cost overruns generally, you'll see it if you're looking at additional man and machine hours. Your procurement specialists will see this, especially your technical people. Additional materials and equipment parts, how many spares do they have? Barriers to entry for the best suppliers. Some suppliers just won't come because it takes too long to get paid, because they're not sure that the contract will be honored, because they're not sure that they can execute it with all of their obligations that they're taking on. I talked earlier about lower production rates of natural resources. That could be billions, tens of billions, and is something to pay attention to in a significant way. Revenue and cost sharing imbalances, particularly on PPPs. PPP contracts are risk allocation mechanisms, and those take into account what it's like to do business in each country, as well as with each entity that they're working with. And then a higher cost for any good or service with risk built in. Now, the elephant in the room is that every risk of your departments, partners, and suppliers is a cost to you, which is good in a way, especially if those entities are doing risk management. Because if you ask, what is your risk, you might get an answer. Sometimes they won't share everything with you, but not just understanding your own risks or enterprise risk management, but understanding the risks of your partners and suppliers. Also your departments. So we don't often talk about the cost of risk as it relates to internal activities. But if you have a legal department that has certain risks, or an entity in one particular region that has risks, those are going to be passed on throughout the system. And you're looking at an upcharge at every level. So I'm going to pause for a second and ask for comments on how you eliminate the cost of risk. And Mr. Riaga, if you would give me an answer or two that people are typing into the chat.
Laura, at the moment, there isn't any specific concern or response to your question,
right,
except I know the first answers has come in. How do you eliminate risk? Mark Stone says by mitigating the risk.
So that's exactly right, right? You can't eliminate the risk. You cannot make it go away. The cost of risk will always be there at some level, which is why accountants shy away from it, because it's uncertain, because there's not something that you can do that says whether you're right or not. So eliminating the cost of risk is impossible, but mitigating the cost and fully understanding the cost is possible. And so that starts with doing the assessment, right? We do a risk assessment, but also assessing the cost of risk. So you can't do it alone because other parties hold critical information. Asking questions and building a risk management approach based on cost and exposure is the only way to really look at, to understand the cost of risk and to do something about it. So when you ask your partners, what are your most significant risks? You can do this in contract negotiation. You can do this prior to negotiation. If you do it afterwards, you've already signed up to their costs. But there may be ways in order for you to mitigate that. In some countries, we've seen significant costs in security be managed with security agreements between the local security agencies or the domestic security agencies in order to reduce the cost of security contracts. Same thing on insurance. When there's a third-party insurer, there are mechanisms to reduce that, especially on massive projects. Asking the question is the best way to get an answer. Asking better questions is the best way to get better answers. So asking about total risk, the highest cost risk, the highest likelihood risk, highest impact, highest frequency, and highest velocity. Now, understanding those will get you started in a good way. I've added frequency and velocity, which are less talked about. Frequency is the one that happens most often. Now, that could be access to a location. It could be something that happens in a transaction, and those transactions happen every day or every minute or every second. Velocity is how quickly it'll become a big issue. So this often relates to safety issues and environmental issues, but it can also be public relations issues. So something that will start small but happen quickly. And the answers to those will give you information on how to best mitigate the issue, how to best assess the cost of risk, and then put controls in place in order to have a less costly, more robust framework. To ask your suppliers who are in a procurement process, or those who are in a budget process, how are specific risks impacting your budget or proposal? When you're looking at time, man hours, machine hours, non-productive time, insurance, and security, those are all pieces. And those are pieces that I have a small business. Swale House Partners was started 10 years ago. I had spent 10 years working in government, managing oil, gas, and mineral projects, advising on them for foreign countries, but managing US government projects. These were huge. The insurance was huge for every supplier that we had. And so my job was to manage the entire $300 million government program. But I had to ask those questions: is, how much are you building into weight? How much are you building in for insurance? And I managed that with blanket insurance, government provided security, structures on non-productive time, where we asked them to let us know when they had non-productive time that exceeded 2 days, and with foreseen greater than 5 days. So it's not a costly control. It's just an information management system that allowed us to be able to manage that more effectively. And we probably saved, with very expensive consultants, over $20 million each year, just by asking the question, when do you have non-productive time, and restructuring our activities. What risks caused you not to submit a proposal? So if you are talking to bigger companies and they decide not to submit, understanding why they didn't could give you significantly valuable information to manage that in the future. How is risk impacting your internal discount rate? Unlikely that you're going to get an official written answer on this question, but it's a good one to ask outside of the official questioning, because most entities want you to know so that you change it. But the discount rate, if it's high, could be a significant barrier to entry, or will impact the cost of everything else. It'll be in the upcharge for all costs. So risk management and information. Most of you have probably seen this matrix before, but for those of you who haven't, it's my favorite. We don't know what we don't know, and that is costing us in terms of risk, right? Risk is the impact of uncertainty on objectives, and if we don't have the information, it's all uncertain. The unknown knowns, this one on the top left, is a very interesting one because that means that somebody knows it in the system, but the decision maker does not. So this is about asking the right questions. If you can ask the right questions and understand how it impacts, how any uncertainty can impact your objectives, you can turn those unknown unknowns into known unknowns, which means that you know you don't know, but you can get the information somewhere. And then the unknown unknowns, just asking the question. So you're moving from the left and from the bottom up to those known knowns where decision makers can use relevant information. So using risk management as a tool to flow all information into that known known or an acceptable unknown. We don't know, but we don't have time. So we're going to move forward acknowledging there's a gap in the information. These are all useful concepts to make sure the unknown knowns is the easiest one to fix because you just need to make sure that you're asking the right people. Tensegrity risk management. So we use the word tensegrity a lot. Tensegrity is a civil engineering concept of tensional integrity. It's represented by a system of rods and strings where the load on any part of the system is optimally distributed within the system. So in tensegrity risk management, the entities are the rods and the interconnections are the strings. And risk management serves to make sure that the strings are effective distributors of load. So if you're looking at the supplier is one rod, the government procurement department is one rod, the operations department is another. Others are those that are impacted or influencing the system. Now, this system, this concept is being used in robotics in uncertain situations, in disaster management. What happens when you have a fire, but you can't send people in? These systems can be delivered by drone and deal with any uncertainty. They're being used in the new Mars rover. So the design is used in bridges. It's used where you're not really sure what the load is going to be or what the shocks are going to be, but you need to be able to make sure that the system doesn't break. So we like to think of that as risk management, as keeping the load distributed, but also ensuring that the systems don't break.
Laura?
Yes.
Are you able to enable us to move at the same pace? The slides seem stuck at the very one where we are assessing the cost of risk. We're not seeing the metrics.
Oh, I am sorry. Let's see. Okay, I'm going to
Are you able to move your presentation? Laura, can you hear me? Sorry about that. I think we seem to have lost Rola, but we'll share the presentation from our end as she tries to join in. Technical team, kindly give me a heads up if you're able to see the presentation.
The presentation is showing. Thank you.
Okay. Rola, are you on now? Sorry, participants, we seem to have lost the presenter. We're making all efforts to have her join. Okay, she's here. Rola, I'm sharing the presentation. Are you able to see it? Rola, can you see the presentation? Rola, can you hear me? Delegates, our sincere apologies. We are trying to get through to the presenter. Seems we have a technical glitch, but we're in the course of rectifying it. We should be on in a couple of seconds. Rola, we can see you in the presenter's room. Kindly check your microphone.
Okay, can you hear me now?
Yes, Rola, we can hear you. Thanks.
Okay, I'm so sorry about that. All right, so can you go back to the risk management information with the matrix, just so they can see it?
Okay, thank you. Yeah. This slide?
Yes, thank you. So just so you all have an understanding, that one is particularly valuable, but all these slides will be provided to you. It's a simple matrix, but it is really useful to understanding how much where you are in the system, and that each of those transitions can save an incredible amount of cost. And I talk about cost because I'm an accountant. Risk managers will talk about managing the most amount of risk, but as it relates to accounting specifically, this is where you can start to quantify 1, 2, 3, 4% of value. Sometimes you're looking at doubling the value depending on where the risk is and how you manage it. All right, can we go to the next slide, please? Thank you. So the tensegrity system, since you didn't have a chance to do that, to look at that, that's what the system looks like. If you search tensegrity images online, you'll get a lot of different components, but the key function is that, key components are that you have rods and strings and they are interconnected to optimally distribute load. You'll find bridges, you'll find artwork, and then you'll find robots that are like this, where in this case, in this image, the silver items on the yellow strings allow for control of how much tension is in between which rods at any given time, allowing it to move independently. All right, next slide, please.
Rola, is it showing?
It hasn't moved. Can you see my slide changes now? Is mine showing for you?
Can you see?
I've put mine back up just so. Yes, can you see now? All right. Is everyone okay with this? Are we seeing it? All right, so when we talk about, good, thank you. When we talk about risk treatment in a tensegrity system, it's the same 4 T's of risk management: terminate, transfer, treat, and tolerate. So terminate or restructure activities likely to fail, transfer risks or share risks with entities with full capacity and appropriate oversight, share risk treatment among parties that have the capability and understanding to execute the treatment. And all residual risks will be accepted or tolerated by the entity, whether they understand them or not. So the tolerate is an important one because it's all being tolerated if you're not managing it. I asked a question to a class last year and said, how much risk are you willing to tolerate for cyber risk? And the answer was none. And then I asked how many people were on the hotel Wi-Fi. And so the reality is that you are tolerating risks, and understanding that is incredibly important. Documenting that is more sensitive, especially in government, because not every government department can write down all of the risks that they're willingly accepting and still stay in government from a political perspective. But having an understanding of risk will get you to understanding what you're tolerating. Risk treatment in a tensegrity system. We use this system at Swale House Partners to build control frameworks. Once you understand the cost of risk, you can look at the directive controls, which are the ones that tell you the rules. What are the rules? They must be clear and concise. If they're not effective controls. So those are laws, regulations, standards, contracts, SOPs, anything that tells you how to get it right. I do a guest lecture in corruption and governance and ask the question, how do you not be corrupt? Seems to stump a lot of people, but as accountants, you know that it's all based on systems. You have to tell people what to do, not just what not to do. Preventive controls, how do we follow the rules? So these are the review and approval of plans, budgets, your partnering agreements, and these have to be competent and sufficient. So if you're reviewing a budget or a plan or a proposal, you have to have people who understand what is being proposed in order to do that effectively. Detective controls, how do you know if the rules were followed? These are reviews, inspections, audits, investigations, etc. And they have to be timely and appropriate. So if you do an audit 4 years later, you're going to get a lot less information than if you do it as soon as the information is available. It also has to be appropriate. So following audit guidelines, but also these days, most audits are done on a risk-based system. And then corrective controls, knowing what you're going to do once you find something and having that plan before. If you don't have that plan before, it gets political very quickly. How do you correct the situation? A lot of these are already established in your contracts or in the rules. They could be contractual remedies, additional controls, legal recourse. Somebody could be fired, a contract could be canceled. There's all sorts of corrective controls. But if you identify something that is a high value issue, having those corrective controls identified and agreed upon prior to finding anything is a really important part of the system, or they generally don't get executed the way they should. So working together in a tensegrity system, it's all working together. Accountants are critical because they see the information. They're the ones who see it in the paperwork. If you see that costs are greater than they should have been, your variance analysis is a critical component to this. Risk managers, they'll see the risks. Administrators will see what's not working properly. Lawyers will see, particularly on the directive and corrective controls, they'll see areas that aren't being executed as they should. Contract managers, I put partners here. Partners really are anybody that you're working with who is outside of your own entity. Department managers, leaders, and policymakers. Building questioning competence. One of my brilliant colleagues from Norway, she's about 80 now, and she said that questioning competence is the biggest thing that she is able to convey to people who are new. So if you're new to risk management or you're new to operations or it's a new industry for you, building your questioning competence is incredibly important. And that's just asking better questions, right? Better questions get better answers. Building that starts with risk management training, in my opinion, because it allows you to identify uncertainty. Even if you're not a specialist, you can ask better questions if you understand risk management and the impact of that uncertainty and the ability to ask questions within that system with those words. Risk workshops, understanding risk with your colleagues. A risk workshop is a facilitated activity where all of the important people are in the room sharing about what's uncertain and what they're worried about and what they're doing about it. That can give you an incredible amount of information in a very small period of time. It's like a one-day audit where you get all the good information. Translating your work into the language of risk. It is, for me, the only language that crosses disciplines. So lawyers, operations people, accountants, engineers, they all can talk about risk, but they can't necessarily speak in your language. So as an accountant, if I'm speaking to an engineer, they're not going to understand what I'm saying unless I can talk about how it impacts risk. And then we can all start to understand how to work together to manage that. Translating your operations, your procedures, your contracts, laws, and regulations, and your policies into risk language will help you understand and manage what you need to do for your job in order to manage and impact how the entire system works. Professional conferences are a great way if you look at them through the lens of risk. So AAAG events, these are fantastic if you're looking at what did I learn? What did I learn about uncertainty? How do I manage it? CPA Society activities, great, especially if they are industry-specific CPA Society activities. Government conferences on different activities, PAFA activities, ICGFM activities. ICGFM is the International Consortium on Government Financial Management, and we have a conference in DC every year. Many accountants general from Africa have joined in the past. Mr. Riaga has presented on risk management in the past. And we this year are dealing with asset performance specifically. So oil, gas, mining, transportation, communications, public real estate, all of these issues have a big risk component and the uncertainty associated with how these assets are performing. And then technical and supplier conferences. In addition, you've got surveys that you can send out anytime to anybody and tip lines. If you're a risk manager and you don't have access to the tip lines, find out how you can get access to a summary, because they can be incredibly valuable in figuring out what people are concerned about. And so to conclude, governments carry the overwhelming majority of the cost of risk. It is being that cost is being transferred to you through risk transfer. And that's done on purpose. In a lot of cases, governments are willing to accept that, but they don't necessarily understand how much it is costing and how to better manage that cost or reduce the cost. Risk management is an invaluable tool for assessing, quantifying, and managing the cost of risk. So if you're taking the risk anyway, if you are doing risk management effectively, and I hope this goes into the next presentation, because Alan has done a wonderful job in Uganda with implementing and facilitating the implementation of risk management systems in government. The results of effective government risk management create more resilient people, systems, and institutions. You'll be more resilient, it'll cost less, things will be more efficient, you'll understand more, and you'll be able to be a more functional tensegrity system. And then keeping in mind that time is the ultimate non-renewable resource. It is critical that whatever your actions are, whatever your information is, it's flowing efficiently so that decision makers can make those decisions, because time is costly. It's costly to everybody. And it all ends up at the feet of the people who are contributing to government revenue. So at that, I will thank you all for your time and attention and apologize for the technical difficulties, but I'm glad we got back on track. And feel free to contact me anytime. I love talking about this. I will be at the ICGFM conference, and I am doing a specific class through the Institute of Risk Management on managing risk in contract implementation coming up in November. So I hope that we have a chance to have some discussion, and I appreciate your time. Thank you very much.
Thank you very much, Rola, for that insightful presentation. And indeed, you've brought out quite a number of things. That risk is a hidden cost embedded in every government activity, and you highlighted that often exceeding up to 10% of total spending. So it would require and affects an impact on financial, it has impact on government spending, and yet it is one area that we normally do not pay attention to because it's not something that we see in our ledgers, in our balance sheet. And interestingly, I think you implored us to treat organization as interconnectedness, using the tensegrity concept derived from civil engineering. That approach leverage clear control frameworks, as well as would help us in terms of using the 3 T's of risk management to terminate, transfer, treat, and tolerate. Ladies and gentlemen, the way we've structured this presentation, after Rola, allow me to bring in the next facilitator. Then afterwards, we'll be able to ask the burning questions, and already I can see some coming through on the chat. The next presenter, ladies and gentlemen, who will share the perspective from Uganda. He is a chartered accountant with over 10 years experience in risk management, financial management, and auditor. He's currently working for the Petroleum Authority of Uganda as a senior risk officer. He's also a facilitator with insurance training and has also worked for the Office of the Accountant General in Uganda. He sits on various committees, most of them from the risk angle. He has also facilitated several trainings, including at our sister organizations, the AfroSai, Organization of English-Speaking Supreme Audit Institutions. He holds a bachelor's degree in business administration from Makerere University and a master's in energy management from Robert Gordon University. Ladies and gentlemen, allow me to bring in Amanya Alani Kabiasiki from Uganda. Amanya, over to you. Amanya, your mic could be on mute. Amania? If you're talking, Amania, your mic is on mute. Technical team, please assist with the connection with Amania. Amania, if you're talking, your mic is on mute.
Bruce, as we try to get hold of Amania, on the chat there was some specific comments which we can then take advantage of the small window possibly to address.
Okay.
Can I answer the question on asset management in the Q&A?
Yes, sure, Aurora.
Excellent, thank you. So it's a good question when you're talking about asset management and mitigating the risk of breakdowns can happen through clear maintenance plans. But you're right, limited resources, there is a difficulty in doing that. However, sometimes we look at limited resources and say, well, we can't do anything, so we'll just take a loan or we'll deal with it when we get there. Just because you don't have the perfect control doesn't mean you don't have any controls. So really looking at what the risk of breakdown is, looking at redundancy and looking at the system as it comes together, understanding what the risk and the cost of those breakdowns are, and then looking at the cost of risk management and saying, okay, if there's a significant likelihood and we take that likelihood percentage times the impact, then we can go through and say, okay, that's the cost that we're pretty sure is going to happen. And here's our associated cost of maintenance. You will likely get pushback to say perfect maintenance isn't an option. And then you can talk to the engineers and say, what actions can we do for this specific budget that can reduce the risk or give us a better time frame for what that breakdown looks like. So you can get more information and ask better questions once you have more information. But just saying, well, we don't have enough money for maintenance. Maintenance is a very broad term. And so looking at an appropriate and reasonably cost maintenance program may be an option for you. So, and risk mitigation in your chart of accounts, you'll likely not. Risk mitigation is your maintenance, but risk management should be a line item. Every government entity should be authorized with a risk management line item. Yes, we can. I hope there's a question.
Yes, Alan, we can hear you.
Oh, sorry for that glitch. And I request you also share from your side. I think I'm also having difficulty sharing from here. So I request the team on that side to share the presentation.
Okay, thank you.
Go through it.
Shiloh, please share the presentation.
All right, thank you. Thank you, TD.
As we wait for the presentation to be shared, first and foremost, it's a great pleasure to speak to this great audience on the subject that I'm very passionate about. Like Laura said, we've worked together on this area of risk management. And I'm always passionate when I get an opportunity to speak about it, and most especially to such a wonderful audience of accountants. Because as custodians of financial integrity, it's important that we understand this concept, we have an appreciation of it, and like I've been given an opportunity, I'll take you through risk management from the extractive industry perspective, sharing insights into how we have managed risk in the Ugandan extractive industry. So I hope today we're not just going to talk about the risk theory, we are going to focus on the cost of risk. I think Laura has done justice in this area. So my presentation should be able to spark more than just awareness it's a practical session to show you some of the things that I've managed to do as Uganda. So I believe you can put this in presentation mode, and then we get into the presentation. Thank you. So if you could scroll.
Can you see the presentation?
Yes, I can. Yes, I can. We can move on. Let's move. So this is going to be get back to presentation outside. This is what, if you could go back. One more slide back. So this is what we're going to focus on. We shall just have an introduction, have a brief overview of the extractives, have a look at the risks that we have encountered in the extractive industry, specifically in Uganda, have a look at the cost, what has been the cost of these risks, under control. Then there have also been some lessons and best practices that have been learned from this. So next. So we are all aware that extractive sector or industry, it's high value, and of course with a high value, it also carries a high risk. It carries multidimensional risks across the various segments of the value chain, from the upstream to midstream to downstream, from exploration to development, production. So it's a sector that is faced with a number of risks. Risks, some of which I'm sure most of the countries in this code have the extractive. Issues to do with resource mismanagement, corruption, environmental harm, community conflict. There are quite a number of them. And of course, like what Laura had said, that every risk has a cost. And costs may manifest in several ways. These could be losses, this could be mitigation expenses, or it could even be missed opportunities. We can move on. So I thought it's important that I give a background, as I give a perspective of the Ugandan extractive. It's important for the audience to get to understand what extractives we have in Uganda. And of course, we understand that extractive is both oil and gas and the solid minerals. So this is just a snapshot for the oil and gas, with over 21 oil and gas discoveries and 88% drilling success rate, one of the highest in the world. As of now, we have 6.5 billion barrels of oil, but of these, 1.4 are recoverable. More explorations are being done. We hope the resources to be enhanced. We are into the development and soon getting into production phase. And 80% of the exploration area where have been discoveries have been licensed for development and production. And we host one of the longest, if not the longest, crude oil pipeline in the world, running over 1,443 kilometers up to Tanzania, in Tanga. And we hope also to have a refinery which will be refining over 60,000 barrels of crude per day. We can move to the next slide. So this is the overview of the oil and gas sector in Uganda. So in the next slide, if we could quickly get into the next slide. So we also have minerals besides oil and gas. We also have minerals in Uganda. There are quite a number of minerals. You can see the map of Uganda is fully mapped with minerals. We have over 20 established mineral deposits in the country that include gold, copper, lithium, lead, iron, and many others. And maybe it also, as one of the risk mitigation, as we'll see later, we're a member of the EITI, the Extractive Industries Transparency Initiative. And we expect mining to be one of the major contributors to our economy as a country. We expect that we would grow the current economy from 53 billion to over 530 by 2040. So I think you can see the magnitude of the extractive. So with that in mind, having had the background or the perspective of the status of the oil and gas industry and minerals, so this is our perspective regarding the risk, how we've managed to control the risks and the costs that are associated with the risks within this high-stake, high-risk industry. So this is the Ghanaian perspective. So if you could get onto the next slide. So there are many facets of extractive industries. So I just tried to highlight a few to demonstrate some of the risks that have been seen in those areas, give you some of the risk cost insights, and also some of the controls that have worked for us to try and mitigate the risk. So in terms of governance and institutional arrangements, and you find these areas applying across all countries that are within extractives, we always have governance and institutions that manage the extractives. Some of the risks we've seen in that area, we've seen institutional overlap due to poorly defined institutional roles or mandates. In circumstances where you have mandates that are not clearly defined, then you're likely to have conflicting roles or mandates. So we've seen instances of political interference. You must agree with me that this is a highly big risk that most extractive industries face in all jurisdictions. Weak oversight and also issues of accountability. These are very pronounced in extractives because of the nature of the industry. So when we look at the cost insights, trying to look at the costs associated with these risks, the billions could be lost due to corruption or mismanagement and lack of accountability. If you have weak oversight, there's no accountability. You have institutions that do not know their mandates, and so you're likely to suffer from these. Fortunately, we've not had losses in Uganda, but we are aware that this is a risk that affects most countries with extractives. But however, there are some controls, because having a risk without a control, then it could be poorly managed. So, but there are controls that have been helped us as a country. For example, clear separation of roles amongst the Ministry of Energy, which has been charged with policy and oversight. We have the Petroleum Authority that I work for, which is responsible for regulation and then assessing that there is compliance with the license requirements. Then we got a National Oil Company that is managing the commercial interests of the state. So clear separation of roles is very key in terms of managing issues to do with governance and institutional arrangement. So if we could get to the next slide. Then another area that is very key when we are dealing with risk in the extractives is revenue management. Of course, there are a number of risks. You'll agree with me that some countries have suffered from this misuse of oil revenue. There's been corruption. In some countries, they have caused macroeconomic instability due to revenue volatility and overdependence. You know, the oil and gas revenues, the minerals, they bring in quite a lot of revenues. So if you've not planned very well as a country, you're likely to suffer from this risk of macroeconomic instability. So it's something that we need to be aware of. And of course, the cost of risk associated with such is that mismanagement would lead to macroeconomic instability. And in some cases, social unrest may have a pricing from the citizens, demanding for accountability. You may have unrest due to inflation, due to too much money in the economy that has caused macroeconomic instability. But however, as a country, there have been controls put in place. We've had the Petroleum Fund, which has ring-fenced spending, whereby the petroleum revenues, where we expect to get most of the revenues in extractive, the fund has helped us as a country to try and organize to ensure that this fund, the petroleum revenues, go to do budget support and also infrastructure development, not just for recurrent expenditure. And also the Petroleum Fund has been periodically subjected to audits by the Auditor General and has been also oversight by Parliament. So all these are controls that are aimed at managing the misuse of oil revenue or curbing corruption. And revenues have been integrated into a national development plan to manage the revenue prudently. So you can see that for each risk and associated costs, then you must design controls as well to ensure that you're able to deal with them. So that's what we have done in revenue management. If you could get onto the next slide. Another aspect that we need to be aware of and be keen about in terms of risk management in extractives is environmental and social. We have risks like oil spills, we have biodiversity loss, we have community displacement, and of course, all these risks come with costs. There are costs associated with cleanup, the fines, the reputational damage. Most of you must, or some of you might be aware of a famous oil spill in the Gulf of Mexico, how it costed one of the companies, BP, billions and billions of dollars. So this is a big cost that you can pay if you fail to manage risk very well in that space. However, as controls, the mandatory environmental social impact assessment to ensure that we take care of the environment, the environmental bonds to take care of such disasters that might happen, and the commissioning plan to ensure that you restore back the areas the way you found them at the time when you started the oil and gas or extractive activities. And of course, there's been oversight by the National Environment Management Authority to ensure that there is total compliance. So then another aspect is on the next slide that I think is also very important to look out for contractual and investment risk. There are quite a number of risks that are associated with this, and the investor disputes, the fiscal unpredictability, capital flight. My colleague talked about issues to do with the supply chain and procurement. So all these have costs that, for example, like delayed project implementation, unattractive investment decision. If you have investor disputes and you have fiscal unpredictability, you may not be able to attract investment into the country. But however, as a country, we've tried to ensure that we deal with some of the risks by using the production sharing agreement with clear fiscal terms. They provide for clear way of cost recovery and production sharing mechanism. We've also put stabilization clauses to reduce investor uncertainty and dispute clauses. In other cases, we've even provided for international arbitration to ensure that you deal with the risk associated with investor disputes and fiscal unpredictability. So then next. Legal and regulatory, it's also an area we have to be aware of. Risks, the number of risks within that area, the contractual disputes, the regulatory gaps, the legal ambiguities, because when also coming up with these contracts, you may not foresee everything. So you find that at times you find the gaps within the negotiated contract. So, and the costs associated with this, sometimes they result into project delays, where there is back and forth negotiation, there are penalties, and even end up in costly litigation. But controls have been put in place to ensure that we have a robust Petroleum and Public Finance Management Act production sharing agreements that have given clear contractual obligations to try and minimize the risks associated with the ambiguities and regulatory gaps. So then on this issue of transparency and disclosure, we have risks that we must be aware of to do with opaque contracts and disclosed revenues. And of course, when you have this, like the costs associated with this risk would be corruption and loss of public trust if there is no openness in terms of contracts. If the revenues are not disclosed, then these are likely to suffer from such. However, we have a number of controls in addition to audits, external audits that are done by the Auditor General, controls such as being member of the Extractive Industries Transparency Initiative, which allows us to make things clear and open to the public. So all these are controls to deal with such risks. If you could move on. Next. So, having talked about, kindly go back to our previous slide. Okay, so we need to, having from the Ugandan perspective of the extractives, there are lessons that have been learned, and these have been derived from risk management. And some of these lessons from the risk management have informed policy action and practice, and helps us to close the gaps where they have been existent to ensure that the extractive industry is able to move forward and achieve its desired outcomes. So if you could move on, I would just take you briefly through some of those that we have learned that we could also speak. So some of the lessons and the policy actions that have been derived from this or practice is that identifying risks through past mistakes. There have been failures, there have been missteps within Uganda and even other oil-rich countries like Nigeria, Angola, Venezuela, but there have been lessons learned from the risk management perspective that weak institutions and poor oversight lead to corruption and mismanagement. And of course, coming from, if we put in the risk lens, some of these have informed policy response. For example, separating the roles, that is separating the roles of the regulator, the ministry to ensure that they're focused on policy, and also the national oil company to ensure they take care of the commercial interests of the state. And this has ensured institutional independence and checks and balances. So these are so that is a strategic direction that has been taken as a result of some of the risks being identified through past mistakes. And we've seen in some countries where this, and we have learned from, for example, the National Oil Company of Nigeria, NNPC, to once combine the policy, regulation, and commercial roles, leading to inefficiencies. And as a country, we had to learn from this, and we took a more structured approach. If you can get onto another practice from, get into the next slide. Then also evidence-based policy design. We have used data from pilot projects, SGAs, stakeholder consultation, and regional case studies to understand risks and stakeholder expectations. So the lesson we pick from this is that unplanned developments cause local resentment and conflict. And of course, having understood that the policy response has now focused the laws towards public consultation in environmental assessments and community development agreements, and that these are mandated and they are a requirement. Examples of such, we've seen conflicts in the Niger Delta, showed by ignoring communities, which led to long-term security and reputational risk. So as a country, we design policies requiring local stakeholder engagement to ensure that their views, to ensure that their aspirations, to ensure that they are captured so that we avoid some of the risks associated with that may arise due to local resentment and conflict. So we can get to another. Then also another one is precedent-driven legal and regulatory updates. So gaps or legal disputes in the petroleum contracts highlight areas of ambiguity, and from this we have also picked a lesson of poor contract design exposes the state to fiscal and legal risk. And of course, having understood that as a lesson, Uganda has now designed a production sharing agreement with clear defined terms, dispute resolution clauses, and fiscal stabilization provisions. Of course, these are contracts that things already emerge. We cannot say they're 100%, but then at least they have gone a long way to ensure that they deal with such. If an example of such is that global investor-state disputes have informed Uganda's inclusion of international arbitration clauses in the PSAs, because we've taken note, we have seen some of these international disputes arising and done a case study and tried to ensure that some of our contracts that we are coming up with at least take care of those issues that have already been identified. Then we have crisis-informed reform, significant environment or social incident, e.g. land displacement triggers public outcry or litigation. So all these are showing you the different sources of areas where risks can arise. And so the lessons we pick from these is that this social risks, if they're ignored, they can escalate quickly. So risk management has informed or shaped the policy response or action through strengthening the grievance redress mechanism, community consultation, and resettlement action plan requirements. We've had some in areas where we have challenges in land acquisition, like for the pipeline. They have informed us as a country to ensure that next time as we undertake resettlement action plans and community compensation plans, they are more detailed and they focus on the desired outcome. So if you get onto probably the last one. And of course, one thing we must know that extractives, for example, Uganda is we may soon be an emerging oil producer. So it's important to incorporate external advisor and technical assistance. We've seen the development partners like the World Bank, NORAD, that uses the Norwegian aid, the National Monetary Fund. They provide advisor insights that are based on global practices. So it's a lesson that we pick from there, that if you're able to take some of these initiatives, you're able to improve and manage the risk associated with improper practices. So the policy response, some of these that we have become members of global transparency bodies like EITI. We have adopted beneficial ownership disclosure, and we have legislated transparency in the Public Finance Management Act. These are policy responses to address some of the risks that have been identified. You can move on. So in summary, we have seen that there are a number of risks that have been identified within the extractives. There have been costs that have been associated with risks in extractives, and there have been lessons learned from this that have informed policy actions. So lessons have been learned, and some of these lessons have formed inputs from our past experiences that have informed design of policies and regulations. We have translated these lessons into policy reforms. Lessons have helped us to formulate risk controls and strategies, because if you're aware of the risk associated with corruption, mismanagement of revenue, and it's a risk that you have identified as a country within your extractives, then it helps you to formulate controls and strategies to deal with this. The lessons have been very key in integrating in our policies. It's a continuous process that you applying a policy and you still identify gaps or risks, and then it's a continuous integration. And of course, there's been adaptive governance and improvement, whereby policies have been updated based on lessons learned to address some of the emerging risks to avoid them recurring in the future. Next, I think our last slide. Next one. So in conclusion, go back, the previous one. In conclusion, we can say, drawing from our perspective as experience within the extractives, that in resource-rich countries, the true value of extractives lies not beneath the ground, but in the strength of the systems that manage it. Yes, we understand we have the value in the ground, but the true value lies in the strength of the systems that manage it. Without strong proactive risk management, the cost of risk, such as project delays, revenue mismanagement, disputes, corruption, and environmental harm can quickly outweigh the benefits that we have in the ground. It can all get lost. So the takeaway is that managing the cost of risk is not optional, but it is essential for translating our natural wealth into lasting and inclusive development. That is the only way we can realize revenue, we can realize value from our extractive industries. Otherwise, we stand to lose or not benefit from the value that it offers. So next. So thank you. That is the brief about the perspective of Uganda as regards extractives, and I thank you. I'm available to clarify where I've not been clear. I thank you very much for being a wonderful audience. Thank you.
Thank you very much, Alani, for that insightful presentation. And indeed, you've closed with a very strong takeaway. The true value of extractive lies not in the ground, but in the strength of system that manages it. And that's important and cuts across every facet of public sector that needs to manage the risk. Alan has touched on a couple of things where we need to have clear distinction in terms of separation of duties to mitigate government risk. We need to have policy and oversight standing alone. We need to have regulations and compliance on the other side, as well as commercial interest, as has been alluded to in the case of Uganda, where the ministry manages the policy, the Petroleum Authority covers regulation and compliance, whereas the Uganda National Oil Company comes in to take commercial interest. And this way we'll be able to approach to mitigate some of the risk that Alan alluded to, political interference, as well as accountability gaps. But also, I think Alan brought in a very important part on the need to reinforce revenue, which is embedded in the cost of risk in national planning. With that, ladies and gentlemen, allow me now at this point to open the floor to ask to bring in our questions that we need to clarify on from the two presenters that we've had. You could either raise your hand or type your question in the chat box. Ladies and gentlemen, at this point, the floor is open for your questions.
Bruce, can we address the questions that are already in the Q&A?
Okay, we can start that with Rola.
So if I can start, and I'm sure we can get some additions from Alan on this because it's related to petroleum. So Raymond was asking about risk management being very important for cost management, but it's not well considered. How do you encourage management, right? And this is a big question, and it's an important question. And we talked about the cost of risk today rather than risk management because that's what what changes management decision making. When you identify how much money is being lost unnecessarily or how much money could be made, each line item is going to be different. Each procurement's going to be different. So I would encourage you, if you're looking at changing management's mind or encouraging risk management as a process, that you really start with the biggest money issues and the biggest questions. So if you're asking your suppliers, what's your biggest risk and how much is it costing you? Pick the top one, the one that everybody says is an issue. And talking about the elephant in the room, it's the one everyone knows about, but no one's really talking about. But don't just say how big of a problem it is. Suggest that risk management as a function and targeted risk management to this issue specifically will help build a better control framework in order to reduce that risk, and that you can prove that it's being reduced and help them prove that to their management. Politics gets in a really big way, and it's important to be able to give your bosses what they need in order to make the case above you and above them. And the other question Raymond asked was about petroleum. And petroleum in Ghana particularly is a big opportunity. So it's a royalty tax regime, but the profitability factor determines the domestic price of gas, which then affects just about every industry that's using electricity or gas directly. And so understanding what the cost issues are, the costs in petroleum are hugely uncertain, as are the revenues. So looking at where there's uncertainty in those contracts. We have a product that we call a rights and obligations assessment, where we go through every line of a contract and see where there's uncertainty in the implementation of that term or that clause and how it's going to impact the country. And so we go through this with our legal colleagues, sometimes our client legal representation, and just sit and go through each one and say, okay, here are your big five where there's uncertainty and opportunity for making more money or reducing costs, increasing profitability, increasing taxable income for large taxpayers. These kinds of things can be done, but they have to be done methodically. And accountants are a really good place to put it, because you're used to going through things in that manner. So hopefully that answered the question. Sam, and then Alan, do you want to add to any of that?
Thank you, Laura. I think you just spot on. When you're dealing with risk, you deal with the elephant in the room, what everyone is talking about, what everyone is being affected with. And that ties into, in risk management, is that we deal with the topmost, and the topmost which we derive from our risk ranking. So I think it's something very important that is a key takeaway for the audience, that when you're dealing with the risks, you start with the elephant in the room as you cascade downward. Thank you.
Okay, Rhoda, maybe also attend to this question. There is a burning question here that has been asked in terms of how the cost of risk can be accounted for in the financial statements, as you have stated that the cost of capital are prone to high risk and become costly to government. Are you able to speak to that?
Yes, so the cost of risk is embedded. However, if you can evaluate the cost of risk in certain line items, particularly in borrowing rates above international rates, if you're talking about it from an accountant's general perspective, you could put it in a disclosure. If there's a policy or a requirement that says that you have to disclose what the estimated cost of risk is. It's difficult to determine with significant accuracy, which makes it difficult to account for, which will frustrate every CPA in this virtual room. But there is an opportunity to really look at it and say, okay, the cost of borrowing above LIBOR is the cost of risk of doing business here. The cost of delays. This is where the surveys and that slide on where you find that information is important, because that is what allows you to say it. You can ask your suppliers, how many extra man hours are you including just in case? What is the cost of security? What is the cost of insurance? And then looking at benchmarking those on international rates and saying, how are we comparing? A lot of companies will give you that information because they want you to help lower it. It helps them increase their profitability as well. And that's where we talk about the tensegrity interconnected systems. But accounting for it and putting it on a line item, it's not likely going to happen or be able to be evaluated with sufficient accuracy to put on the financials.
Great, Rola. There's also another question, and I know you've touched on it, but possibly amplify it and follow up, maybe together with Alan Osok and Kamin. There is a question from Muhammad Fresley. He wants to find out what is the formula for the cost of risk. Then secondly, there is also a related question where how can risk be a part of the budget in any government?
Okay. So the cost of risk is the cost of the impact. So you take the likelihood percentage that you expect and multiply that times the impact, the cost impact of something going wrong or something going right, depending on what you're evaluating. Plus or minus, depending on which side you're looking at, the cost of your risk management activities. So if you're looking at the cost of risk that your production in oil is going to be less than optimal, right? That cost is probably going to be, let's say, 10 billion for Uganda over all of the exploration and production that they're looking at the moment. So you look at 10 billion times the likelihood that that's going to happen. Now, Uganda has put in some incredible risk mitigation efforts, and so the losses are going to be significantly less than they would be otherwise. And comparing your inherent risk to your residual risk is a useful activity. I feel like I'm getting too much into the details on that, but yes, the cost of risk is just the cost of the impact, the financial impact of the uncertainty. Okay.
Thank you very much. So participants, if you want to raise your hand, please feel free, but we still have a couple of, or if you want to type in, please, you're also welcome. Alan, there is a question in terms of, okay, this one is related to Ghana. Now, on corruption, what instruments have you devised to counter risk related to exploration? Then, Alan, as you answer that, I would also want you just to amplify. You talked about a production sharing agreement. Please amplify in terms of how this system works and how it contributes. It has successfully contributed to managing the cost of risk in extractive industry in Uganda.
Thank you. I'll start with how the production sharing agreement works and how it has helped in managing risk in Uganda. Production sharing agreement, it works in a manner that the companies undertake the responsibility of doing the investment. Then when it comes to production, that is the investment from exploration to development production. So when it comes to sharing the production, we have a formula which is embedded within the production sharing agreement. And this, in Uganda, it's structured in this manner. We first recover get-off royalties. Then after deducting off royalties, these are paid to the host communities or the host government. Then we also deduct what we call cost oil, the costs that have been incurred in trying to come up with that production. And in Uganda, we have capped them to a certain percentage that you can't recover them 100%. You keep recovering until they get eventually recovered. Then after recovering the cost oil, then what we are remaining with is the profit oil. So it's on the basis of the profit oil that the government shares with the companies or the investor or the oil companies or the international oil companies. So that is how it works. You get off the royalties, get off the costs, and share the profit. So as a government, you don't have anything to invest other than giving in your resource, and the companies exploit it to be able to derive value for you. And how this has sort of minimized mismanagement, or how it has been a risk measure. First of all, we know some of these industries, a country like Uganda had never been into oil production. So trying to get your resources and invest into unknown territories, you go into exploration, which you have never done before. The high chances that you might hit dry wells and you lose money. So there technically, you may lack the technical capacity, ending up losing your financial resources in exploration. Also in terms of the market uncertainties, you're also sort of covered because these are companies that are international in nature. They know how to market a commodity. So once you get to sell the crude, then you're able to share part of the profit. So risks, they cover technical risks associated with the project because they're investing in, so they're also providing the technical capacity, I would say.
Okay. Thank you very much, Alan. At this point, let me allow the participants. We've had hands from Mr. Dyson Sipawe. Mr. Sipawe, kindly go ahead and ask your question.
Thank you. Yeah, I would want to know, in a situation where the management is not agreeing on the cost of risk, how do we do with that scenario then? Can you hear me?
Yes, so it's a good question when management disagrees. And part of that is to get management to highlight what they're concerned about and highlight areas that are important to them. But management will likely disagree unless you have a solution. If you have a solution that helps them. Now, understanding politics, I had to go back to graduate school to understand government. I studied accounting as an undergraduate and then studied public administration, specifically in energy. But I didn't understand why governments didn't make obvious decisions based on risk and finance. So understanding the politics and really highlighting the risks that matter, because once you get management to care about risk management, your management systems will be so much better. But it has to start with an area that management is willing to support. So I would suggest that risk can be evaluated in many ways. Start with the one that matters, that's big, and can be seen as a political win. And sometimes I feel disingenuous to my CPA roots when I say that, but the reality is it won't be implemented unless you have management support. And so work with them to identify something that will be valuable to both your department and your managers.
Yeah, thank you, Laura. Well noted.
Thank you. We also have Anya Haram. Kindly proceed to ask your question.
Thank you so much, Alan and Laura, for that wonderful presentation. Alan, you cited copiously your experience from what transpires in Nigeria, and you said you've learned a lot of lessons, and I'm wondering whether you actually have the knowledge of the rot in an MPC, Nigeria, and all the all the things that accumulated into the state of disrepair we are in that situation, and how really Uganda would be able to leverage on such understanding. However, my focus is on the tone at the top, because no matter how effective the risk analysis or the risk mitigation mechanisms put in place, if the tone at the top, and that's what Dyson was talking about, both the management and the political head, if the tone at the top is not effective enough, how do you think countries in Africa will wriggle out of this situation, corruption in particular? That's my concern. Thank you.
Ellen, do you want to start on that one?
Yeah, thank you. Of course, in risk management, it starts with tone at the top. You'll agree with me that it's risk management is a fairly new concept that for it to be able to become effective, it must be supported by the tone at the top. There must be executive support for it to be implemented. So without the support from the top management, from the executive, from the decision makers, from the political heads, then you're not likely going to implement much, because risk management ties into policy, as you've seen in our case, that it informs policy decisions and policy practice, it shapes policy direction. So if there is no buy-in at the top, then definitely these policies will not come through. So it's very important that we have that support from the top executive. Laura, you could
Yeah, thanks for that. And you're right in that it's the tone at the top is necessary, but presenting information to the top with an understanding of the pressures that they have, whether you agree with them or not, is important. And as you look at Nigeria and the divestment strategy now, to take cash out of the system is an opportunity. Anytime there's disruption, anytime there's uncertainty, anytime there's an election, there is a better opportunity to reevaluate risk and how it relates to political management or political leadership. So looking at a system, while it may be imperfect, where there is an opportunity to really highlight that you can use risk management and a structured approach to getting them what they want, while also getting what's good for the country, and aligning those through the Accountant General's office or through the other relevant offices. It's about understanding what management needs and what risk management can provide for them. And there is big opportunity right now in Nigeria with the fast pace of change, which will be seen by accountants as negative in many cases, particularly in Nigeria at the moment. However, there is an opportunity there to really put in some better policies, laws, and structures to promote better governance within Nigeria's system, especially as an NPC becomes a non-operating partner and non-majority partner in some of these contracts. That getting the right partners in is a huge opportunity to produce more, receive more, and structure them differently. So as political leadership is looking to pull cash out of the system, more cash can be pulled out if the sale can be better. And the sale can be better if you can reduce the risk of operating through what Alan talked about in certain components of those production sharing agreements. Certain clauses will reduce the risk for the operators, and then really increase the buyout rate. Now, the second risk or the layered risk comes in how the governments are managing that revenue. But in terms of getting the best price for the sale, there's a big opportunity right now in Nigeria through NNPC.
Okay, thank you very much, Arola and Alan. Now, Alan, there is also a follow-up questions from Nesbet and Seleng. I've combined them because they're similar in a way. They are asking, from your experience, what are the significant implications of incorporating core public financial management components like revenue collections, public spending, and cash management into a strategic risk management? As you answer that, Alan, also add on procurement, how does this impact the procurement, which is also a huge part of the government budget? Alan, over to you.
Thank you. Thank you. And I will try to draw an illustration or use our case here of how the strategic risk management ties into the public finance management. We are currently trying to pilot something to do with work plan and budget alignment and risk alignment. whereby we, as a country, we align our budgets to the areas where we have the most risks, because we expect that the resources should be pointed towards areas that require mitigations to be undertaken. So the public spending should be guided by the risks that we have as a country or as a sector, so that we allocate resources towards managing those risks. Otherwise, if you don't direct your public spending to mitigating the key risks that you face as an economy or as a sector, then you're likely to miss out on managing those risks. And also ties in with the procurement, because procurements usually they're made to meet certain objectives. For example, if you do a procurement for a road network, you must have envisaged the purpose as to why you're undertaking that road construction. So it must be aiming at addressing a certain risk that you have identified. For example, movement disruption. So in brief, what I can say is that risk must align with the public spending, must align with the public finance of any given country, must align with the priorities of any given sector, because only that you put resources to mitigations that you can be able to deal with the risk associated with that, the identified risk mitigation. I hope this provides some clarification.
Okay, thank you. Roll-up, attend to how the internal auditors and risk management officers can collaborate to manage risk across the organization. And I think the issue of corruption keeps on propping up in the conversations, and we just want to see how best can you embed a risk management culture within a public sector that will be able to address the issue of corruption. Aurora, over to you.
Okay, so it's a huge question. And it's a question that has excess to $1 billion impacts. Corruption is everywhere, in every country in the world, and is managed through process. If there are processes that are well executed and you can evaluate the residual risk from that process, you have more of a chance than just about anywhere else. There's a book called The Reckoning about the rise and fall of nations based on public accountability. And it's a very useful book, but corruption can't be managed as corruption, right? Anti-corruption tools alone, transparency alone, enforcement alone won't solve anything. Having good process and risk-based processes are essential to manage corruption. If you are looking at your process and you can overlay risk onto it and identify the areas within that have the most risk of corruption, where the process itself will be corrupted or whether the individual can be corrupted within that, it will allow you to allocate resources to those higher risk areas in more specific ways. So if you have an opportunity to do risk management, you can identify the risk of corruption. We do not talk about that as a private sector entity. Working with governments, talking about the risk of corruption is usually not a good way to be hired by governments. However, we talk about the risk of leakage and the risk of inefficient use of resources. It's all the same. It's about where you're not going to be getting an optimal return or optimal performance from your system. So, and if you could ask the other question again, besides corruption, I focus too much on the corruption piece.
How internal auditors and risk officers can work together to manage the cost of risk.
So in my opinion, internal auditors are the most valuable, least used resource in government. They're the loyal opposition. They have access to most information, and yet nobody wants to know because they see them as not contributing to solutions. So internal auditors and risk departments in particular can really, really change the game if they start looking at how can we help, and they are seen as helping the the line ministries and the entities in which they work perform better. So changing a bit of the language of how risk information is presented to leadership and the boards from internal audit and those risk offices. From that situation, you really do have a lot of power. And I will say that Uganda in particular has done a good job using their internal audit office, but there is a huge opportunity to really expand how that function can reduce the cost of risk and really unleash better performance across the board.
Thank you, Rola. Participants, please feel free. We have a few minutes. Feel free to raise your hands if you want to ask. But if you still want to type your question, you can still go ahead. Rola and Alan, there's also another issue that has been, okay, before I go to that, allow me to bring in Maro. Maro, kindly go ahead. We can see your hand. If you are talking, you're on mute. We can't hear you. Maro, if you are talking, you're on mute, we can't hear you. Okay. So, Rola, there is also a burning issue, and Mike as well. There's a burning issue in terms of how do we embed the risk, the cost of risk into government financial management systems.
Yeah, and thanks for that. I think the question is relevant. What do you do today? And what you can do today is start talking about risk. Start looking at the biggest issues, the elephants in the room, where everybody knows what the issue is. But if you can look at quantifying the issue and building a control framework using that system. So I love the 4-control system because usually those controls are executed by different departments. But starting to look at your processes and where you're losing money or losing performance or where there are opportunities. Start with issues that everyone knows about: high security costs, high borrowing costs, unnecessary borrowing costs, delays in approvals are usually a good one because that's fully within government. Well, it's within government control to the extent that you control the approval. But understanding instruction of why those approvals are taking a long time can really assist in that process. So if you have a specific example, you can bring it up. I highlighted before, you can send me an email. I'm happy to answer. I love this stuff. Alan loves this stuff. And I've also recommended that AAAG has another discussion of this where you guys can bring up your specific issues, because your daily work will already includes risk. If you can start talking about it with your colleagues as you execute your tasks, you will find that you can improve optimization or improve performance every day that you're communicating using these tools.
Okay.
And the primary tool is the language of risk.
Thank you very much. Maybe as we wind up, before I bring in CEO back, and allowing you, the two facilitators, to make your final concluding remarks, just share with us, there is a question on what risk assessment frameworks or methodologies have proven most effective in capturing credit, contractual, and political risk in large-scale, complex public sector projects. So both of you can attend to that as you wind up and give your concluding remarks.
Alan, do you want to go first, or do you want me to?
Alan?
All right, I'll start. So risk assessment frameworks, you can use, there are a lot out there. I will say Kenya actually had a pretty good one. I don't know if it was ever officially approved. Fred, I don't know if you can share that. There are some out there publicly available, but really it's about applying risk management. So ISO, COSO, and the IIA have good courses on it. It's really just about building a simple structure to start. And when you look at credit risk, contractual risk, political risk, have a workshop these are elephants in the room that most people will already know about. You can bring in the partners, you can bring in industry representatives, you could bring in Alan, you could bring in me, you could bring in a lot of people who can help facilitate these types of discussions, but the reality is you already know them. It's just about putting them in a matrix, identifying what the cost of risk is. So what's the likelihood, what's the impact, what's the uncertainty associated with it, and then really deciding what to do about it. These are well-known issues. It's just about interpreting those well-known issues into your specific situation and specific contractual clauses. And so let's see. And I mean, your questions are excellent on contingent liabilities and long-term financial commitments and cost assessments. Contingent liabilities are a risk in themselves, and it's about reducing the likelihood of that happening. Once you account for them, I'm a huge proponent of accrual accounting because it allows you to address a lot of these pieces that you wouldn't see in your normal existing cash accounting systems. But to complete this discussion, or at least put a pause on it because we have to finish, it's been a pleasure to talk to you. You've opened up some excellent questions, but continuing to ask questions about how you implement risk management. Don't start with a huge risk management framework and a policy that is required. Start with something you can control, something in your own department, and use the language of risk to really be able to build consensus among your team and the team below you, and then present actionable quality information to your managers so that they can solve the problems that are important to them. Big enterprise risk management systems are great, but they require tone at the top. And sometimes you don't have time to wait for that or the ability to influence that. But you can start within your own system. And I would say start there, start cheap, start free. Just use the language of risk to talk about the existing elephants in the room.
Thank you very much, Rola. Alan?
Thank you very much. As I also close, I want to say thank you for all your time, attention, and engagement on this important topic. We've not explored just what risk is, but how it can translate into tangible financial costs. But if we don't manage them well, they can undermine the achievement of our objectives. And of course, the role of accountants in this equation cannot be overstated. You are at the center of the risk visibility, from budgeting and forecasting to reporting and compliance. So you play a key role that is very unique in ensuring that you influence how your institutions not only understand risk, but also how they proactively plan to respond to it. Therefore, I encourage you that you continue integrating risk thinking into your financial processes. You ask critical questions like you've been asking that have intrigued our thinking, and also enhance collaboration. Risk management, it cuts across different disciplines, and no one has monopoly of information. So you only enhance your understanding through collaboration. So as we walk away from here, let us know that risk management isn't just a box to tick, it's a value driver. It's about protecting resources to enable investment, support decisions, and it's at our heart as finance professionals. Thank you very much, the AAAG team.
Thank you very much, Alan and Roland. At this point, allow me to bring in the Chief Executive Officer of the association to give the concluding remarks. Mr. Riaga.
Thank you, Bruce, and thank you, Laura Robinson. Thank you, Alan Umanya, for those very insightful comments on this topical issue of risk management. Ultimately, I think from the discussions that we've had and from a public policy point of view, the eventual losers in scenarios where public discourses or public policies implemented without a mindset to anticipate and factor in risk management is compromised service delivery to the people, which would eventually lead to a people that are disenfranchised with their governments, bringing about issues of trust deficits with government. And consequently, the idea of implementing government decisions become fairly expensive. So risk management undertaken more proactively in government would generate far much value than we have thought of. We live in an era where, as I like saying, that public expectations keep on growing every day, whereas the environment for government, the fiscal environment within which government operates, keeps on tightening by the day. So the cost of unmanaged risks is therefore just too high to ignore. So those of us and the accountants generals and the public sector accountants that are here, and of course, the general consumers of public goods, we must start thinking proactively on how to identify these risks, assess them, and put in place mitigation action plans so that we're then able to manage the consequences. And remember, I said the consequences go beyond the financial losses, which we have been accustomed to defining the losses in, but the fact that we get to erode erode the quality of public service delivery, and which then eventually, as I've also mentioned, would all equally erode the trust that citizens place in their government. We must act decisively. We must look into the future. We must sit back and embed risk assessment in planning and budgeting so that the cost of delivering public services is then brought to a manageable level. I think through the presentations, I picked some critical points that I also highlighted, I picked, which I may need to underscore. From an African point of view, one country was reported to have said that cost of corruption consumes about 30% of the aggregate spending. And when I compare that with the 10% that Laura did mention, then I guess 30% is significant, is a significant portion that we must really focus on and take deliberate efforts to manage them. Because if we lose 30% of the aggregate spending, how much of the public needs would we end up not meeting over time? I wish to indicate that it is a pivot moment for we, the accountants and accountants in public sector occupying leadership roles, to start thinking of embedding risk management into the core of our public financial governance through ministries, departments, and agencies, because remember, these are the centers at which a lot of the pilferages do happen. Through the presentation, I've picked the necessity to institutionalize robust risk management frameworks. But and of course, I would also wish just to discount that slightly in light of the comment that Laura ended with, that when you think of the robustness of a risk management framework, the complexity around it, then you would then stop at the point that you do the initial policy making, the establishment of your risk management frameworks. But think small, chop it bit by bit, plan well, integrate a risk assessment and a risk mindset as and when we are budgeting, as and when we are planning for projects, as and when we are running through the implementation of these projects. Then of course, the heavy weight of risk management would have been cut to manageable levels. We, as AAAG, are teaming up with the accountants across Africa to build capacity. to anticipate and respond to both strategic and operational risks that may hinder successful implementation of government programs. Culture is at the center of it all. We need, for us to drive risk management and in a manner that enables us to manage public expectations and meet them, accountability and transparency, which has been the running call through the presentations today as the main driver of risk within public sector. We will then need to inculcate and nurture the culture of accountability well. The stakeholder engagement, citizens' involvement in public, so that we then enable public discourses. They are a critical partner or stakeholder that if we bring on board, we are then likely going to succeed in shoring up the level of compliance in governments, having managed the risk exposures. So my running call would be, we need to prioritize risk management, not as a bureaucratic checkbox, but as a strategic imperative. If we are looking at rolling out resilient governance arrangements that would foster efficiency and effectiveness in the provision of public services, to enable us as government leaders to restore public confidence in governments to a level that our citizens would then be fairly easy in paying the taxes. They will be fairly easy in teaming up with government through PPP to fund government projects and hence bring out the help manage the fiscal constraints that beset governance as we speak. Thank you very much, delegates, for coming through. Thanks to the accountants general who are in attendance. Thanks to Laura and Alan for sharing your day with us. We have learned immensely around this topic. Expect more to come. We will assemble these presentations. If there are any further questions that you may not have had an opportunity to ask, please feel free to jot it down and send it to us on info@aag.org.zm. We will do more of an FAQ in liaison with Laura and Alan on this topical matter and send it back to you. Thank you so much. We are looking forward to continued partnerships with you, even as we drive capacity building, not just in financial reporting, but on other aspects of governance that equally play a role in ring-fencing the public finances for efficiency and effectiveness. Thank you so much. Have a good evening.
Thank you.